Hello everyone, let's just jump straight into this. SPY, Dixie, and the long end, and what's the outlook for the next 2 weeks, and what's going to happen with the markets before the 31st of this month, meaning the FOMC and QRA announcement, both of which the major catalysts, QRA, I would argue, the more important one, that have a power to change the direction on a trending basis for all markets, for currencies and everything else. This move in SPY, this move in equities, this major repricing high came back on the back of essentially this. Let's open up TNX. Came back on the back of this rally in TLT, essentially in long end. This is largely over on a short-term basis, meaning for the next 1 to 3 weeks before the 31st of this month. We will not get the continuation of this move, and if anything, the long end is signaling the continuous grind higher from here, and we believe the long end will remain in consolidation before the 31st of this month in an upward sloping consolidation. All of this puts pressure on SPY. But right now, the pressure is disproportionate, meaning that if the long end is going up, it doesn't necessarily mean that the SPY has to break trend or go lower significantly. Equities generally express and remain resilient if we don't get this in the long end. Equities don't have to crash if we have some consolidation in a certain area with relatively low volatility. Equities can remain bid, and if earnings come in greater than expected, which once again we argue that they will because the expectations are low and it's much more easy to beat those expectations, equities should do quite well once again for the next 1 to 2 weeks before the 31st of this month. This is the outlook for the 10-year and 30-year, and for the long end generally. We'll get to 2-year in a second. Therefore, if we think this is going to happen at the long end, once again, let's put on the Dixie on top of it, and let's put the SPX on top of it as well. Let's actually just invert the SPX. Oh, I cannot invert it, but I think it's going to be instrumental anyway. You can see on a trending basis, everything is perfectly correlated. SPX falling lower as the rates rise, as the dollar rise. Rates exceedingly falling faster and faster. SPX moving higher significantly, and dollar falling. As soon as we get this, on the day, essentially to the day, rates breaking trade, moving higher, dollar moving higher with the rates. And SPX, what is SPX doing? Remains in consolidation. Our outlook is that rates will remain in consolidation, upward sloping consolidation, and SPX should not break trend, but it will remain in consolidation in around this area until the earnings come in. Yeah, so for the next 1 to 2 weeks, you should not be making any major asset allocation decisions or putting on a significant and long-term bets in this moment just before we get this crucial events that are coming in. For the dollar, once again, from the perspective of why are we saying that long end will likely to remain in an upward sloping consolidation? Because this is essentially the signal. That's what the signal is saying. We've just created a intermediate higher low on a trading basis, and in order to reverse and continue with this trend, if you think that it is going to continue, first of all, we need a catalyst for this. This catalyst might be this FOMC and QRA, both of which we think is not going to be that positive for the long end, and we will not see this again for the next, just in the near term, in the intermediate term, we're not going to see this anymore, because essentially there will have to be another step function in a coupon issuance from the Treasury. Yes, this rally came on the back that they shifted the issuance largely to the bill side, and there are no coupons, and supply demand once again, and we balancing those out. This move came on the back that they announced that they were going to issue a lot of coupons, and market moving on the rate of change basis. If they announce that much coupons, maybe the next one will come in even higher, and even higher. Once again, gross issuance is rising steadily, and will continue to rise. It's been 18 billion in the previous quarter, 816 billion in this quarter. It will be more and more in 24 and 25, more and more, especially with these higher rates and the amount of bills that we issued. Treasury will have to repay all of this in a years come, and they will have to issue more and more. So gross issuance is coming up, and then look at the composition, and they announced a lot of coupons right here. Move higher. They announced a lot of bills right here, an inordinary amount of bills, and they've been issuing 300 billion in coupons previous quarter. Right here, they announced 370 billion. Just 70 billion more. They still issuing shit ton of bonds, of coupons, but the rate of change shifted significantly, because the 2 quarters before that they've been issuing 150 billion, and they jumped straight into 300 billion, and the previous quarter they jumped only to 70 billion because of that excessive bill issuance that they've been able to do, because there is an RRP facility that they can target, and this idle money can likes this safety, and likes the relatively higher rates that you can get from the short end from bills, and they just flock into this supply. This thing is in a couple of, maybe a month, 2-3 months, is no more essentially, and we're getting into real problems. Will they be able to maintain this rate of excessive bill issuance, or will they have to shift into something more normal, meaning let's say 50-50 coupons to bills? Then once again, how is this thing is going to fall from here? How the hell is this going to happen? It is in best case it's going to remain in consolidation, and in the worst case we're going to see the same thing happening. Very unlikely that they are aware of these supply dynamic problems. They are aware that they are essentially in a fiscal dominance. They will have to do something with it. They had this nice trick up their sleeve in the form of RRP. There's a lot of idle funds lying around. Right now, it's either banks, with the upcoming issuance, it's either banks will buy those coupons and finance the government via drawing from their excess reserves, which Federal Reserve, they are already pretty low. They are close to the boundary below which the Federal Reserve would like those excess reserve not to go below. Either they change this boundary, or one way or another, banks will have to absorb that issuance, or Federal Reserve will have to restart QE. And if they do that, holy smokes, this is so significant, much more significant that whether they're going to cut 50 basis points or raise 50 basis points. This is the crux of the deal. We understand the destination. We just really don't know, because we haven't seen that happen, how the path is going to play out if this QRA announcement is going to get another step of function in coupon issuance. This is not going to be good for the long end. Long end, largely at this point, is not about the future growth or inflation expectations baked in. No. It's that. It's some sort of this, and the supply and demand dynamics. And this supply and demand dynamic is much more important to the direction of the long bond of the U.S. Treasuries than the growth or inflation expectations. But in any case, inflation expectations also not really playing for the Federal Reserve on the Federal Reserve side at this point, because the 5-year inflation forward swaps also begin rising. Because where are they? They should be higher just a little bit. This is it. This move, and This move means that the term premium will have to rise because there will be less demand on the margins for those long-term bonds. Because why? Why would you buy the long-term bond and 3%, 3.3%, 3.4%, while inflation is 3.4% and even re-accelerated a little bit? Okay, but it did re-accelerate. And the Federal Reserve is saying they are done hiking rates and they are going to cut this year by 75 basis points somewhere in that region, and market is pricing in 150 basis points this year. So what are we talking about? What are we talking about? This thing will have to expand higher. So a lot of negative things for 10-year, but this thing moves in waves, in cycles, and you have to recognize that. You have to recognize that inflation and growth expectations do play a role in this, but right now the supply and demand dynamic is very crucial to understand, and understanding the plumbing and how RRP has been influencing the long end will help you to understand, will help us to understand what's the next play right here. And by the looks of it, with the pace of the RRP drawdown and how the money, essentially the last week, we think what happened with the 2-year right here. Why this move happened, and it completely decoupled from everything else, essentially. Everything else, with the higher inflation print that we received on Thursday, everything else moved like it should have moved. The dollar moved. Initially, it moved higher, but then the two-year yield came down, and something happened there, and dollar just remained in consolidation for the next 2 days. And since this Tuesday, we ramp up higher. This is essentially what's supposed to happen when you get the higher than expected inflation print. The dollar went higher, significantly went higher. The long end went higher, significantly went higher. Right here, we can see that. And stocks, obviously, because stocks completely at the mercy of the long end. There are positive dynamics, and that's why we're saying if the long end remains in consolidation, then you should be long equities. But completely at the mercy, on the trending basis, completely at the mercy of the long end. And the 2-year moved lower, decoupled from the Dixie, decoupled from the long end, decoupled from everything else. It inching back higher, but why this move happen? Me thinks that this is connected to the RRP facility and the speed at which it dropped previous week. It dropped by $90 billion. It was $690 billion, and it ended the week at $600 billion. By this rate, we're gonna RRP will hit zero in 7 weeks, in around 7 weeks, if we continue at this pace. What's going on there? This money is leaving the RRPs and going into money market funds. Money market funds invest in the short-term bills, short-term paper, meaning bidding up the 2-year bonds, and what's going on? Yields are dropping right here. So the money, RRP, money market funds, and Federal Reserve balance sheet. Money market funds going up, RRP going down, and who buys the treasury issuance? Treasury issuing the paper, and it's either banks with their excess reserves, or this thing will have to go higher. You have to watch this thing very closely. And they will give some color on this, and they will definitely will be asked this at the next FOMC press conference. But this is the game is going on, and this is why the money market funds this is why the 2-year dropped significantly, even though it was completely out of line with the overall macro space. So with what's the 30-year and the 10-year doing, the Dixie is likely once again to remain bid until the FOMC, and as soon as the FOMC comes out and the QRA comes out, this will be a significant decision which will give us an idea whether we are breaking the trend resistance and effectively establishing the tail higher low right here. And this is a very monumental and very strong signal. This means that rate at the long end continue to go up, and the Dixie will go up back to 107, 108 and higher. Or we're taking out this trend resistance. This will happen if, let's say, they will issue bonds, a lot of bonds, There will be another step function, but the Federal Reserve will announce that they are tapering their QT. Even if they announce that they're not going to fully stop the QT or even restart the QE process, just taper the QT. Markets know how to react to this. If they do already announcing the tapering, it means in no time they will increase the tapering and restarting QE. Essentially, markets will get ahead of itself and price everything in an instant. It will be as if they announced the QE already, even though they said that, well, we're going to taper a little bit QT. And this will weigh heavily on Dixie, and maybe they will take out the trend resistance and continue lower. This will be essentially breaking out the tail, and Dixie will absolutely explode on itself, which is positive for stocks. And the other scenario, the former scenario that I described, is negative for stocks. But for the next 1 to 2 weeks, dollar will likely to remain bid, and this is where we're going. If we're going there, and dollar will likely to remain an upward sloping consolidation, putting pressure on equities, as the long end is doing. Bitcoin already broke the trade support and establishing negative trade momentum, potentially signaling the creation of intermediate lower high and continuation lower. So we are taking a breather for Bitcoin, and it's brilliant. Once again, I've already alluded to this. The lower we go, the better will be the buying opportunity. So if this is the case for the Dixie, if this is the case, once again, the gold is signaling the same thing, and gold will likely do nothing until we get resolution in the long end. If this is the case for the 10-year, if this is the case for the intermediate high low creation, and we're likely going back to 4.3 right here. If you look at the TLT, it means that we are going back to the last major level that we have before the all-time low right here. Is this reaction function that we received from, I gotta change this into, what is it? Let's put on this. It's the previous all-time low right here, the cyclical low, and means the previous trade support. We're going back into. I have no doubts that we're going back right here, and then our effective range is this intermediate lower high and this previous trading high low, and this is our range before the FOMC and the QRA. So equities will likely to remain in relatively negative over this period. Yes, we are getting some sort of the Fed meetings and economic data releases, but they are going to be largely ineffective in our understanding of what's going to happen next, and just irrelevant to the bigger picture, honestly. The 2-year will likely to be the 2-year. It's not, dare I say, it is irrelevant at this point in our understanding of things, because it's completely decoupled and it moves with this local supply and demand dynamic that's currently going on. The thing is, which is incredibly interesting, is if I correct in understanding the RRP and why the money going into the money market funds, I don't understand why the STIR market, short-term interest rate market, is pricing in more and more and more cuts. This is why the 2-year went down and the essentially futures went up. Is because there was supply and demand dynamic. A lot of demand came in. Okay, that's fine. But why we suddenly started to price in 150 basis points of cuts? We were pricing in 125, and then on a hotter inflation print, we suddenly started to price in more and more and more cuts. Completely counterintuitive. I guess once again it's all connected to the RRP facility, and let's give a listen to this brilliant explanation of what's going on right now with the RRP, the hedge funds, and the basis rate. And the basis rate is another source of funding for the primary dealers, and why the primary dealers can buy that much, that can absorb that so much treasuries. Let's give a listen to this, and then maybe this will give an explanation why the market at the same time started to price in more cuts.
arbitrage price and the actual price
Give me a second. Let me put this 1.5. It is
of the treasury bond, which does open up the basis trade. But because it's basis points, you need leverage. Now, if the repo market becomes stressed and leverage becomes less available, you get less demand from hedge funds. Primary dealers have to start financing their inventory because they're losing a big source of demand. They have to start financing their inventory. They got to use their excess reserves to get that done.
primary dealers, meaning banks, finance their inventory, meaning somebody has to buy the treasuries. If there is no demand from hedge funds anymore, well, there's no liquidity because the RRP repo market is drawn. They cannot. They need collateral in the form of treasuries. They get that collateral. They go to the repo and exchange that collateral for the money and take the money and engage in the basis trade. If there's no repo, there is no money, there is no demand from hedge funds, primary dealers is coming under stress, and they will have to use their reserves in order to continue the operations as normal. Meaning liquidity is becoming constrained.
Start coming down, they have no choice. They must participate in these auctions, and they must hold. They must buy and hold, and they have to start using their own excess reserves for a period of time. They can't count on the leveraged demand from hedge funds if leverage isn't there. So somebody's going to have to step in and fix that. And that is where the Fed would probably step in and do that. So let's look at what kind of footprints we would expect to see if we're starting to see a buildup of stress for this. By the way, this did happen in, it was 2019, where the repo market became really stressed, and the SOFR rate went way out of line with the Fed funds rate. I mean, way above the upper range. Way above the upper range. The Fed had to step in very quickly to take care of that. We would expect to see...
This is what we're seeing right now. But in a different direction.
The Fed balance sheet building up. We would expect to see the reverse repo dropping. We would expect to see money market funds increasing, because what is happening with the banks when money market funds increase is money is leaving the banks to go into money market funds. If money
just what I described.
Leaving the banks to go into money market funds, you're going to need some kind of help from the Fed. You're going to walk over to the Fed and say, your high rates are killing us. We are going to have to sell treasuries, but they're underwater, and you said for a year that we can come to you and get money as opposed to selling treasuries at a loss. So
he's referring to the BTFP program that has been initiated in March of 2023 when banks failed, and essentially they're getting $100 on that collateral. Right now, they bought a lot of treasuries. Banks were holding a lot of treasuries as their excess reserves, and essentially right now, let's say you get a 50% haircut on that collateral. We have 50% less money. They go to the Federal Reserve, and what they do, they pay you back $100 instead of $50. And it has been announced that the BTFP, if anybody comes, officially it has been suspended. But if any bank can come to the Federal Reserve and say, I still have problems. Can you please renew the BTFP program for us? Federal Reserve says yes, and here we go. Fed balance sheet expands, and we should not have any problem. Once again, this is essentially the infinite QE that we've been talking about. And once again, Treasury issues bonds. Primary dealers right now can go to the Federal Reserve and say, well, we need so and so. Well, thank you very much for your money, for your infinite QE that you provided with us. Let's buy treasuries. Let's use this collateral, and this is the infinite QE. I think market understands this. This is why the long end will likely to remain under pressure, and before this realization hits.
Here I am. Give me my money. And as the reverse repo starts dropping, there is less and less available for the repo market, which means demand from hedge funds are going to have to drop because they can't get the leverage they want, which means it's another stress for the banks, because not only is money flowing out, they also have to start financing inventory on the treasuries that they buy because demand is dropping, which means excess reserves start doing this.
Yep, and this is a vicious cycle, essentially.
And the Fed has a limit to how far down they want to see that go. At a high level, that is...
That's the idea. This is what's going on with the repo market, and why this is important, because it directly impacts the long end of the curve, and long end of the curve decides everything that is going on right now in the market. Every single thing, where the currency go on a trending basis. Once again, there are oscillations on a trade basis, in the short term, on a trending basis. This is the most important dynamic currently on the macro front, meaning currencies, credit, crypto as well. all of the rate sensitivity complex, equity, world equity as well, because most of the world equity on a trending basis, once again, is completely correlated to the SPX, and SPX is completely correlated to the 10-year. This is your blueprint, essentially. This is the most important thing that's going on right now, and this is crucial to get this right. Let's see what's going to happen on the 31st, but this is the idea. That's fine. He referred to one thing. They either why the answer, the potential answer to the question why the market started to price in a lot of cuts, because somebody's sniffing out that they will either have to restart QE or cut rates significantly in order to boost the collateral, because the bonds is underwater, and that's maybe why people are starting to price in and hedge for that possibility. It's all hypothetical. I may be a complete idiot talking about this stuff. I don't know anything about anything, but I do know the correlations, I do know the rolling correlations, I don't know the major dependencies, and hopefully when this thing comes, we will be able to play this appropriately. Maybe not to catch the inflection point initially, but get on the right side, because the trending move, once again, will be significant. That is fine. That's the outlook right here. Well, now let's get to trades. Finally, trades. Finally, HYG. Let's look at the HYG as a flag post. Now, I forgot what the word is right here. As a guideline for the credit, what's going on in credit markets. And we've been, a couple of weeks ago, we've been calling for a potential creation of an intermediate lower high right here, and continuation lower maybe from here. This is your standard retracement pattern. What's going on currently? This move lower will likely to be much less pronounced, meaning there is either potential creation of a higher low above the previous intermediate higher low, or run at 76.55 right here. So once again, no stress, no observed stress, but relative weakness from HYG is on the cards right now, on the table. So therefore, HYG once again is completely correlated. One begets another. You can see the correlation is spot on. It's very, very tight. Get to the SPX, therefore SPY, SPX, and we've been calling for a potential creation of an intermediate lower high right here, and continuation lower maybe right. This is a highly unlikely scenario in our minds, because we just outlined what's going to happen with the dollar, outlined what's going to happen with the long end consolidation, grinding, and at the same time grinding higher. And the SPX will likely to remain under pressure right here, but very, very unlikely that this is your double top, creation of a lower high and continuation lower until the 31st. But very likely, what is very likely is that we are in this consolidation right here in this range, and you should not be fooled by any move outside of this range until the catalysts come in. You can see this. This is quite a tight consolidation we've been in. You could have been fooled a lot of times by these moves. Same thing here. Same thing is happening right here. It doesn't mean that there is nothing to do. It means that you have to keep that in mind. You have to keep in mind the relative weakness of the beta component of your equity plays. But there are plenty of things like we've been discussing. LEU, as a very uncorrelated name in and of itself, is completely dependent on what's going on in uranium space. And uranium, once again, we made a case that this is not the blow off top. This is not the final stage of the blow off top, but maybe just the beginning. And if you want to get in, you have to get in on these days. You don't know whether there's going to be this retracement of this magnitude. As soon as you get this opportunity of the lower price, you get in because the continuation is highly likely. Same thing with LEU. When the UUN does this retracement, shows a little bit of weakness, LEU is a great buy right here. Once again, we are waiting. History has shown that if you take the position before the break of a significant level, you usually have to accept much more variance in the potential price, and your stop is very wide. You either enter at the low end of the expected range, or you enter after we get the move, after we significantly and clearly broken above the level, which signifies a very high likelihood of a potential continuation. So this is not the place to buy. If that is, you want to accumulate the position, you can do this. You can start legging in with a small side right here and get ready to buy if it gets lower, and get ready to add if it gets higher, if that is how you're comfortable with it. But LEU, this is how we play in LEU. The other thing is UTI. I haven't wrote down the thesis on it, but it is very clear. Big beneficiary of the bringing back the manufacturing base, reindustrialization in America, and the trends regarding the blue collar. I will write the thesis on it with the slides and with the ideas outlining it today in a group chat. Other idea is Tesla. Tesla is absolutely atrocious. Once again, keeping in mind the beta component and if you want to play Tesla, the best way to do this is via Catalyst. Catalyst is what is earnings, because the flow is so negative that it has meaningfully shifted the probability that if we do get the negative earnings surprise, we will get something like this once again, and that's where the money can be made. It's quite asymmetric from this perspective, and if we think the beta will remain under pressure, we should start accumulating position in Tesla right now. We did. Let's forget what we did a week ago. We did enter the 215, 210 January 19 put spread on Tesla. We closed already. We closed it and we rolled the profits into the February 16th 195 put spread again, but this time with a 1-to-5 risk reward ratio. That's what we're doing. That's the general idea, and we're definitely going to be holding it until the earnings come out. Everything right here, if we get another retracement higher, this is just another opportunity to add, and we will add to our position. This is how we think of doing this. Tesla is a good standalone short. Apple might be not a very good standalone short, because Apple is unlikely to go down as much as Tesla, if that is, Tesla will go down. But it is a very good relative short, let's say MSFT to Apple, or just a brilliant overall relative short. And this dynamic will likely to continue. Microsoft will remain much more resilient before the earnings come out, which is the earnings on 31st and 1st of February for Apple and for Microsoft. This will continue. You can play it different ways, but the most straightforward one is to buy Microsoft and short Apple. Next thing is a thing that can be played of interest is relative strength in NVIDIA, in overall a cyclical pickup in semiconductor space, in memory space, in networking space. That can be played via MRVL, but the problem with Marvel is the earnings on 1st of March, and it is past that crucial moment in time. Once again, this crucial catalyst on the 31st of this month, and before that it's very risky, because anything can change. Honestly, anything can change. We're leaning toward the understanding and towards thoughts that it most likely everything will be fine, because in an election year, Treasury do understand this supply and demand problem. Federal Reserve do understand. That's why they've already started hinting at tapering the QT program. They will just do something stupid and maybe just restart QT entirely, or taper QT significantly, or maybe Treasury will. There's also a possibility that they will simply start drawing on this 750 billion that they have in Federal Reserve economic. Why Treasury balance liabilities? This is Treasury General Account (TGA), which sits now is completely refilled at 750 billion. They are expectation that they've given us at the TVAC letter outlining that they do not plan on using it. But once again, with this QRA, anything can change, and then they can just, let's say, start drawing by 200 billion. This will be just a brilliant stuff. This will be very positive for the very negative for the dollar, very positive for stocks. And we will make decision when the announcement comes out. That's fine. Nvidia, AMD, AVGO. So the relative strength right here. Nvidia is obvious example of it and how you can play this. Marvel and CMCI. Another interesting thing. The earnings come out on 30th of January. It hasn't not been decided yet, but it does look like it might be a very good opportunity to get into when we retrace into the key area on a weekly time frame with this relative strength from Nvidia. This move on CMSCI game just makes total sense because once again, we expect beta to be negative for the next 1 to 2 weeks. We've just touched the previous all-time highs, which is quite a significant level. Touched it, getting due response into the key supply zone, key supply area, and if that is you want to get long CMSCI going into the event, going into earnings, because you've done your work, you think that this is the sector is cyclically picking up. This name continues to be in the epicenter of the AI revolution, AI hype, and it's not over, then this is the thing that you buy. This is just pure and simple. One thing I can point to, the relative, very similar scenario we happened with AVGO right here. Break into the key weekly level, break into the all-time highs, retracement just before the catalyst, and then catalyst in a beautiful position at the low end on a weekly time frame on a trending basis, and then positive catalyst comes in, and holy smokes. Same thing might happen with CMSCI, but there is essentially one major but. Whether the earnings not disappoint, and if they come out in line, then there's a great chance that we're gonna experience this another type of movement. This is it. This is the idea. Another idea is CMSCI, quite asymmetric, methinks. The next play is very short term, TSM. If we think that everything is picking up cyclically in this sector, TSM is not the name that is going to surprise to the downside or surprise to the upside significantly. But overall, we are in a low end on a trending basis. If earnings come out higher than expected, which is they likely will, there's a high probability that we're going to see the same thing that happened right here, let's say. And if we do see that, the way to play this is with call ratio spread. You can shift this however you like, but you can buy 104 call for essentially this Friday, this expiration, 2 days out, and you sell 107 calls, and your risk reward is essentially like this. These are your break-evens, 104, 109. Your risk to lose $25 right here. The maximum profit is at 107 of $250, which is 1 to 10. It's unreasonable to expect to get this, but anything in that region already creates for you a very, very nice risk-reward ratio. So this is a very short-term picky play, I would say. The break-even at the upper range is 109, and it's quite comfortable. 109 is well beyond the possible ATR on a weekly basis. So this is the idea. This is what we're looking at right now. And the other thing is obviously LMT and RTX. LMT, we've already outlined our thinking right here with the mean reversion play on the defense stocks. There isn't usually, most of the time, there is nothing to do in defense stocks. Trying to time the invasions, beginning of more and more wars is, well, be my guess, it's almost impossible to make money that way. But right now, this unjustified serious drop gives an opportunity for a mean reversion, and this is a very slow-moving name, defensive name, but if the earnings come in and they come in at 23rd of January, which is quite nice. Very close, once again, before that key event that we're looking at. Flow is supportive. The idea of mean reversion is nice. The same thing of the flow. Well, it relates to the flow itself. The sector, we like the sector very much. We like the style factor very much. We like almost everything about this name, and we like the fundamentals as well. And it's also tied to the RTX idea. They usually move like this, yeah, as you can see. They usually stay bound in consolidation, going up one day and engulfing the next day completely, up one day, engulfing the next day. So they do this, which is very unpleasant. It's not very high moving and high volatile stock, but this is what essentially we just see right here. Structurally, if we are correct on this, then this is high probability, like we think that this will continue into once. We bought 416 call spreads, 470, 475 at 16th of February, especially if on the 31st of February everything will be fine. There is a great probability that we close this at 180 and retest the previous tail resistance. This is the idea. With LMT, and the other thing is RTX. It's a little bit more complicated on the fundamental side because of the negative news that came in right here. Everything already was priced. The worst, the left tail was already priced, and now we're just picking up, cyclically picking up. They avoided the worst case scenario, and now we just once again mean reversion, essentially mean reverting move. What the price action, this price action, you cannot pick up much from it, obviously. But the thing is, we are positive on the trend basis, completely positive on the trend basis, broken very key significant area right now, trading above it. If we go lower and dip into this area just before the earnings, which are set to come out at 20, well, they moved them. Tuesday, 23rd, same day as Lockheed. Yeah. That's going to be quite a move. That is going to be quite a move. What we're thinking right here is either you buy 1995 February 16th call, or you buy outright calls on this name. We are contemplating both ideas, but the lower it goes with a relative negative beta, RTX is a great pickup into the catalyst. What's the risk on this? You cannot possibly treat these as two separate plays. This is essentially one single play. So if you say have 0.1% of your capital invested into this, or you're risking 0.1%, or you have 5% of your overall NAV invested into these ideas, you split them in half. You cannot treat these as separate ones. That's the overall take on this. We've discussed Tesla, we've discussed UTI, we've discussed LEU, we've discussed CMSCI and semiconductor space, LMT, RTX, we've discussed this as well. NOC, a very interesting name. Also, it is also fine. It's fine. MSTR, we observing MSTR pretty closely, but no signal as of yet that there is a chance to get in on the short side. We've seen on this. Let me just give me a second just to scan quickly. Lilly. I have nothing to say about Lilly. We're still holding our core long position. Everything is perfect for Lilly. There's a possibility that we can retrace down to 630, 620, but with this relatively positive flow for Lilly and relatively negative flow for Beta once again. If that is we correct and Beta and SPX doesn't break the trend support, which is, well, I just can't imagine what should happen, what must happen before the catalyst. However positive or negative it will be on the 31st that the SPX breaks the trend support. Same thing, it means that Lilly will not break the trade support right here. This is Lilly. This is where you can make money now, and TGX, plenty of earnings will be coming out next week. KRE will, obviously, with rates doing what they're doing, KRE is doing what it's doing, and banks reacting negatively. banks can outperform over the next couple of months if that is something changes positively on the RRP side, and maybe they really restart the QE. LNG in the energy space is nothing. It's short, and energy is short right now. IGIS, CrowdStrike, and generally all the cybersecurity space is completely beautiful, absolutely beautiful, and will continue to run if that is a relatively strange, relatively resilient sector and strong sector is the cybersecurity. Semis, we've discussed this. MU, Marvel, Nvidia, and AMD are the place. If you want to be on the long side, you should have been on the long side for a long time on these. We said a couple of words on Apple, Tesla, Netflix. This is, we've discussed most. One thing, this is interesting and this is bad. Well, no, it's not just interesting, this is just bad. They've just announced previous week that they are injecting another 130 billion in the banking sector, and via some sort of, I don't know, but they are injecting shitload of liquidity. It helps. It doesn't help, essentially. This is significant. It is very significant. It's either this thing goes, just completely obliterates itself like this, or the currency goes. And we are getting ever so closer to the economic problems in China being moved onto the geopolitical stage. When you cannot solve your economic problems, you move it into the geopolitics, and you create problems in geopolitics for everybody. This is the problematic thing. And the other thing is Mexico. Mexico is quite interesting, but with this, once again, as you can see, this is Mexico, this is SPX. Correlation is spot on, perfect. SPX is relatively resilient, obviously, than Mexico, because it's further on the risk curve, and as soon as rates picking up in US, Mexico is going lower, and this just confirms our understanding that rates will grind higher slightly, ever so slightly, more and more. If that reverses, once again, you have, this is your play. Rates high, everything else lower. Rates lower, everything, or stable, everything else higher. This is all you can do right now. And if rates stable or lower, there's brilliant plays like Mexico. There's much better play. This going to be will be outperforming SPX or Taiwan, essentially. Taiwan semiconductor companies. These a lot of semiconductor plays, or Nvidia. Oh my God, India. Or Japan, or these Japanese AI basket as well. Look at these moves. Look at these moves lower, higher. And look at this relative outperformance via SPX. SPX did plus 16% in that recent leg up, and these names did plus 40, accounting for currency devaluation, which wasn't that significant, to be honest. USD JPY. You made plenty of money right here, and currency strengthened significantly from that point. You made even more money on a currency basis as well. Europe is pointing to relative weakness once again on a trading basis. So yeah, that's the idea. IWM is reaching the levels at which you would buy if you were bull, or well, if you want to be long of anything. So these are the ideas. These are the current outlook. Very, very. We are in a very peculiar spot right now. So it's, if clarity isn't there, the best thing you can do is just wait and observe. I would like to end with this.